Hey, what's up, everyone? Welcome to another episode of the Winners Ways podcast. As you know already, this podcast is where we talk about career, we talk about money, and we give you live motivation so you can excel. And today, I'm thrilled to have a guest with us. We have Emmy Sobieski with us. Emmy is going to be joining us, and we are going to be talking about everything finance, career, and if you have that dream of building a wealth portfolio to the tune of $100 million. Emmy will tell us how to get there because she wrote a book, $100 million Careers. I'm curious about that book, and I'm sure you guys are curious too. So we are going to be discussing everything with Hemi. Without keeping you waiting further, let's bring in my guest, Hemi. Hey, Hemi, how are you?
Hey, Bola, thank you so much for having me. I'm doing well. How are you?
I'm doing fantastic. Thank you for joining us today. So, can you introduce yourself to my audience so that they can know who we are talking to today?
Sure. I'm going to start with a story. I first saw someone right in front of my eyes make $100 million with what I called my trade of a lifetime. It was back in June of 2000, markets rocketing 2% higher every day. And one morning I recommended we bet $2 billion that semiconductors would go down.
Wow.
I was betting against everybody else. And I knew that my billionaire boss had hired me to get this one trade right. But as you know, in the stock market, if you're too early, you can lose hundreds of millions. Too late, you lose hundreds of millions. And I told my boss one day, everything in semis is going down 80% from here, because this was at the June 2000, right? It was at the height of the bubble, of the dot-com bubble. And I said, we should sell and go short. And he sold $1 billion in semis and shorted an additional billion for a $2 billion swing in under 2 weeks.
Wow.
And my partners called saying, you're crazy. You're going to ruin the company. I was so stressed out. I was worried I was wrong, but I knew I had to follow what I knew, and follow what I'd done before. And he made $100 million personally on that one trade. And the year before that, I made my previous boss $24 million by running the number one fund in the world.
Wow.
So I've seen what it takes to make big money, but then I make a mistake beyond that. And so a little bit about my background. I started investing when I was 16. And by the time I was 20, I turned $1,800 into $320,000. After grad school, I worked for a billionaire junk bond king, Mike Milken, who taught me about leverage, which went for and against him in the past. Then I worked at Farmers Insurance, where I simultaneously ran a $1 billion bond fund, $300 million energy fund, and a $350 million tech fund. And then I joined Nicholas Applegate, where I ran the number one fund in the world. That was the one up 630% that made my boss $24 million. And right after that, because I was only paid $130K to make him $24 million, I left and I joined a hedge fund. And that's where I hit the trade of a lifetime, making my boss $100 million. And so that's a little bit about my background. And the next logical step in my career, in my story, should have been launching my own hedge fund, which were really popular at the time, or joining a tech startup in Silicon Valley. At that time, in the early 2000s, tech had been killed, so I could have really gotten in and made a fortune either of those paths. And instead, I took a year off to train for the Olympics and compete to try to make it to the Olympics.
Oh, wow.
And I came back to Wall Street and I just played it safe as an employee and not an owner. And it took me 14 more years to make it back to Silicon Valley. And so, since the age of 16, I've proven my ability to generate these huge returns, but I keep missing that second step to own my own firm, to get equity. I played small, I got complacent, I took my foot off the gas. And later I realized if your bank account isn't going up, it's going down. And I'm sure you share that with people on this podcast. I'm sure I'm not the first one. And I had friends on similar paths and they didn't make the same mistake as me. And now they're worth over 100 million. And as I mentioned, my boss made 100 million in one trade. So I've seen it with my own eyes. And several of my younger mentees with diverse backgrounds are millionaires by the age of 30, and they own their own firm. So they didn't make the same mistake because I told them not to. And so stepping back, there's 25,000 households in the US worth over 100 million who are self-made. And the future 100 million households shouldn't just be those who knew someone to show them the way.
Yeah.
So that's why I wrote $100 million Careers, is just to share the rules that I ignored for far too long.
Okay. I know maybe I don't know the rules. I've not read your book, but from what you just told, you have a compelling story, Emmy, by the way.
Oh, thank you.
When you talked about the 2000 financial collapse and maybe the bets that you made, I think we are going through something similar in 2022 because I'm also into the markets and my portfolio, they are not happy currently. All the tech stocks, they are down. Amazon is about maybe 50% plus down. Tesla is down. All these stocks are down. And you said you place a bet. And I'm thinking maybe you did some option trading. I don't know yet. But what do you mean by you place a bet?
So what I did back in 2000
Yes.
was we were at a hedge. I was at a hedge fund.
Mm-hmm.
We had $3 billion long and $3 billion short to play with because we were a fully hedged hedge fund. So that would be if you have, so we considered to have $3 billion in the market, but we actually had 6 billion because we had 3 billion long and 3 billion short, and you effectively borrow one against the other. It's a little more complicated than that. And so in the semiconductor sector, which was what I had called correctly throughout my entire career, we had $1 billion long and very little shorts. We had some options, some things to kind of hedge against our longs, but effectively we were betting $1 billion that semiconductors would continue to go up. And I had called the tops and bottoms of the cycle all the way back until 1996, which people say can't be done, but I had certain things that I looked for, called the top and bottom. So I was hired specifically at this hedge fund to call that top and to say when we get out. And when he hired me, he said, the boss of the hedge fund said to me, "This is why I'm hiring you. I am hiring you to tell me when to get out of semiconductors." And so that moment came. In June of 2000, I typically look for 5 different indicators. And if 2 of the 5 or 3 of the 5 hit, that tells me sell everything. It's going down from here. And 5 of the 5 hit within a 2-day period. And so I said to him, and I had been quite quiet for the 8 months before. He hired me in November of 1999, and this was June of 2000. And I had him buy a little of this, buy a little of that. And all of a sudden I get on the call that morning and I say, "You've got to sell every single semiconductor stock. They're all going down 80% or more. And not only that, but you've got to short them all. And I know, typically, I said to him, I know you like to keep the high quality ones and short the low quality ones. I know that's your model, and that's fine as long as you're comfortable that your high quality names are also going to go down 80%. So very similar to what happened in 2021 to 2022. And so then over the next 2 weeks, and it was a funny time. Sometimes it's hard to short in volume because it's hard to borrow the shares. If everybody else wants to short, then there's a lot of demand to borrow the shares in order to short them. And do you want me to quickly explain shorting?
Oh yeah, please.
Okay, so a lot of people get confused. What is shorting? You're betting something's going to go down. The mechanics of how you do that is, if you think about what you want to do in the stock market, you want to buy low, sell high, right?
Yeah.
Or real estate market, anything. We want to buy low, sell high. So if you think that the stock's going up, then you buy it this year and then you sell it next year when it's higher.
That makes sense.
If you think the stock's going to go down, then what you want to do is you want to sell it now and then buy it in a year.
That's correct.
The only way you can sell something you don't own is to borrow it.
Yes.
So that is simply what shorting is you find someone who will loan you the shares. They get paid a little something. So that's their income. That's their passive income off of the shares they already own. And you borrow it, you sell it, and then later you buy it back. So that's effectively what we were doing. And the easy way to think about shorting is just you're betting it's going to go down, but that's how you do it. And so typically it's very hard to, if everybody wants to short, then everyone's running around trying to borrow those same shares. That the shares will get very expensive. You could have 14% interest rates on borrowing those shares, which really adds up over a year if you're gonna hang on to a short for a year. At the time, though, for us in June 2000, the market was going up 2% every day. So nobody wanted to short anything. So it was very easy for us to sell all these semiconductors. We didn't move the market at all and go short them. And we did it in the space of 2 weeks. And then the story gets even crazier because 5 days later, Jonathan Joseph, the #1 semiconductor analyst in the world, downgraded semiconductors. And it was that same fervor that we had last year in the markets, because there were so many people that were taxi cab drivers and whatnot that owned semiconductors, owned stocks, that he had so many death threats against him that Solomon Smith Barney, where he worked, had to hire 2 bodyguards. And that's where I say even my partners within Palantir were calling me up, just yelling at me. I mean, you're ruining the firm. You're going to take us down. You're going to be the end of us. And I was stressed out, sitting on an airport going, oh my God, everyone, even my own partners in my own firm want to kill me. Wow. So it was a really crazy time. And that's to say, you can't be too hard on yourself if you look back at 2021 and go, wow, that was crazy. I should have caught it. Because every time we're in that kind of fervor, it gets like that, where people just think it's going to keep going up. You feel this momentum, you feel the FOMO, and that was the same in 2000.
Yeah, and I think honestly, we've been hearing about maybe market correction for about 5 years before it actually started happening. Maybe you can think back to 2020 at the beginning of COVID, then 2021, 2022. And right now, I think even 2023, we may continue in the same pattern. But you know and you understand the markets. Novice like myself, we just read in the news what's going on and we try to catch on, right? I like the fact that you mentioned some technical indicators, right? You said indicators, and I'm guessing you were talking about technical indicators that will help you to know what's going on in the market. I've heard several times that you cannot time the market. But if you have the knowledge of the market, if you have the knowledge of the macro economy, you'll be able to, make the right decisions in terms of whether to get in or to get out. So I want to ask you, what are some things that you typically look at before you make any investment decision, especially when we talk about the stock market?
Yeah. So I would say there's 2 types of indicators.
Okay.
You're mentioning technical indicators, which I definitely look at. I look at the 200-day, the 50-day.
Okay.
I also look at fundamental indicators. Okay. So when I was talking about getting out of semiconductors in 2000, those were actually fundamental indicators. Those were, what is the price of dynamic random access memory, and has it gone up by too much? So just very DRAM, that goes in computers.
Yeah.
There's what is the capacity utilization of factories in Taiwan that produce chips. So things like that. So I was looking for these 5 indicators and whether they would hit the numbers that gave me concern. So DRAM, it's a total commodity. It was up 4x versus the year before. It made no sense. There were a couple of things like that I looked for.
Okay.
So it's going to be a similar thing in today's market, because today's market's what's much more interesting than in 2000, right? And so when I look at, I think about it in these 2 pieces. When you have a market that's a bull market that's going up, then you look for your 50-day and your 200-day, and you kind of have an idea. Okay, if the market just continues up and it doesn't go down to cross the 200-day, and even better, doesn't cross the 50-day, and it just kind of goes up every day, and you have a nice bull market, you can pretty safely invest on momentum. And the moment that things start to cross over, your momentum investors get worried and they start to peel back because you don't have that momentum, you don't have that safety. And the concern is that you're moving from a momentum and a growth market to a value market. And so the higher a stock market goes, the longer a bull market goes, the longer the fall is to where a value player would say, now I'm going to buy. So I used to create these spreadsheets where my upside target was a multiple of the growth of the company. So let's say the company can grow at 30 times, then you say, all right, let's put a PE ratio of 30 or 40, and it's the highest quality name in the sector. It's a great sector. The sector's got really high margins, so that's very attractive. So maybe you give it 1.5 times its growth for a price to earnings ratio. So let's say it's growing at 30%, you'd give it a 45% PE ratio, something like that. You say it can go up to there, and then if the technicals allow it, like if it's a nice smooth line up, you can ride the momentum even higher. Then your downside target is when the economy is bad and people are doing layoffs and companies are missing earnings. Does it sound familiar?
Yeah, that's what's going on right now.
And so what do we pay for these stocks in this situation? And there's an entirely different group of buyers who's been almost extinct because of these momentum markets mean that there's less and less people that want to invest with them, et cetera. But there's the value guys and gals that are out there. Right. And they say, like Warren Buffett, what is this worth? What is this truly worth? What is the moat? And they typically will pay 2 times sales. And now, if it's a really attractive market, they might pay 3 times sales. They might pay 1 time sales. The deep value guys are doing it on book value, which is even lower. And so often you'll look at a company, and you can see this actually on the technicals, on the long-term technicals. If you look at the 200-day, but on a 5-year chart, and I have some articles that I can refer your guests to as well that I'd be happy to send. But if you look at the 200-day on a 5-year chart, you will see when Cisco was trading at 88 or something like that in 2000. And one of the guys that I work with, one of the portfolio managers, said the support level, if it breaks through these technicals, where the value guys are going to buy, is $3. Now think about that. This company was the company that sold all the routers for the internet. It was the star company. They didn't really even do anything wrong. And the stock went from 88 to $3. And so that is the problem when you've got a market that's had so much momentum for so long. You have this really long bull market, is you have a very different idea of these 2 sets of buyers. And so if all of the growth and momentum buyers kind of step away, then you're just left with the value buyers. And so you do things with that. That's where they come up with these terms like catching a falling knife. It's not fun.
Yeah, no, not at all. So $100 million. That's a lot of money, Emmy. So
It's
most,
a lot of money.
most of my listeners, they will be thrilled to make $1 million. So how can we tell someone out there, someone listening to us now, how can they make $1 million?
Well, it depends on what your skills are.
Mm-hmm.
Right? It depends what your skills are. So you can make $1 million by investing it over a long period of time, earning 8% a year. And I actually have on my website, emmysobieski.com or 100milcareers.careers. I have a calculator on there where you can put in any amount of money and then see how it compounds, and you pick the number of years, et cetera. And it's called the $100 million career calculator. So it really depends on what you can start with. If you start with $1,000 and start compounding that, it's going to take a really long time. And this is where I say the guys like Warren Buffett, that now I don't know if you've gone to his conference in, his annual conference in Omaha, but I've gone there and he says, hey, just invest in the S&P.
Yeah.
And you'll compound at 8% a year, and that's what I recommend.
Okay.
And that's not really fair because Warren Buffett had Geico, George Soros had the British pound, Mark Andreessen had his, he had Netscape.
Right.
So all of these guys had one big boost to get them that first nest egg, and then you start compounding. So that's the tough thing. Now, if you say to me, somebody wants to earn $1 million in their lifetime, you can get a fairly good job, make sure you save more than you earn, and you put that in the market every year and you compound it, and you will get to $1 million. So but the reality is when you start saying, I want 100 million or I want 1 billion, you do need to get a chunk of money at the beginning.
So can you give us maybe a glimpse into your book, $100 million Career? I just want to, what is it about? Are you trying to teach people how to get to that $100 million figures, or tell us about your book?
Yeah, I absolutely am trying to teach that.
Okay.
And as a level set, there's a whole lot of people that should not read my book, which is a crazy thing for an author to say, right?
I'm surprised to hear that.
But my book is for people that are 16 to 35. They're in financial services careers, or they have an ambition to go the financial services route or the startup route, and they want to work 80 to 100-hour weeks for years. They want to work that hard. They don't want the typical white picket fence balance, plenty of time with their friends and family. And I do show you how to have quality time with your friends and family in the book, but they don't want that. What they want is to get $1 billion or $100 million. And they don't want to end up 50 years old, having spent 2 or 3 decades working 80-hour weeks to be making $1 million a year. They want to have that sacrifice be worth something. But the people that want a balanced life where you work 40 hours, you have a steady job, you have a beautiful wife, great kids, lots of time at home, this is not the book for you. So it's really the book to make sure that if you are just going to put all of your effort into making a lot of money, that you get that payoff.
Okay, no, I like that. So you got to understand the sacrifice to get to that figure.
You've got to want it. You've got to want it. I loved all of my years that I worked 80 to 100-hour weeks. I loved it. My last year at that hedge fund where I had the trade of a lifetime, my last year there, I was hospitalized 4 times.
Oh, wow.
because I was so exhausted, because I was, getting 3-4 hours of sleep. They were all random things, right? Just dehydration, food poisoning, but they're the kind of things that happen when you just work yourself so hard. And the moment that he said, "Hey, I'm shutting down this fund," I sent him an email and I said, "What am I going to do now? You're my North Star." So my book basically talks about the careers that I know,
Right.
which is private equity, venture capital, hedge funds, startups, and board directors, and how to break into those careers, what they're like, stories of my friends that have done it, and then how to make $100 million by being in those careers.
So one more question. How can someone get to, become a part of a board of directors? Because that's part of your expertise.
Yeah, absolutely. And it's something that should not just be that other people that have done it. So the first thing that you want to do to get on a board of directors is, when you're in a startup, when you're working in companies, to get control of the profit and loss, have P&L control, which means you're running sales, or you're the CEO, or you're the chief revenue officer. And you can look on boards and you can see what types of people boards hire. And then if you're at a startup and you help scale a startup from 50 to 100 million, other startups that are at 50 million and want to scale to 100 million will want you on their board. You do some networking, but effectively that's it. And the other path to boards is, if you work in venture capital, you get put on boards. But that's not as much people asking you to be on a board.
Okay. So as we are wrapping this interview, I have some rapid fire questions for you.
Great.
So Emmy, what motivates you to achieve success?
Curiosity.
I like that. What are your favorite book that you read? Two?
Hedge Fund Wizards by Jack Schrager.
So one other question. How do you attain work-life balance?
I view balance very differently. I view it as two very exciting things pulling equally. And I love work, and I love working out, and I love my friends. And so I make time for all of it.
Awesome. So where can my audience find you?
You can find me at 100mil.careers or emmysobieski.com. And also I'm on Twitter, LinkedIn, and I have a YouTube channel. So wherever you are, I'll be there.
Awesome. So, and we also heard that Emmy's book is on Amazon, $100 million Career. If you want to check it out, please go ahead and do it. Emmy, it's been awesome having you join us on this podcast today. I enjoyed the conversation, and I've learned a lot from you. I'm excited. I'm motivated. Let's see if I can get to that $100 million.
I hope so. I hope so. Thank you so much for having me.
All right. Thank you.